Following an extremely positive 2020 for all parts of the global fixed income markets, the first quarter of 2021 has proved to be a much tougher environment. Core government bond yields around the world have moved higher on the back of a larger than anticipated US fiscal stimulus package, as well as the expectations of a vaccine-led reopening which will push global growth higher. And it's moved yields up and has led to global government bond indices posting their worst quarterly return since 1987. Investment-grade credit has also suffered from this move higher in yields. With credit spreads having already reversed most of the pandemic-driven widening that we witnessed last year, there was limited cushion to protect them from this move higher in rates. And although we had a strong economic environment, which did lead to marginally tighter spreads and positive excess returns relative to government bonds, it was not enough to prevent US investment-grade credit posting the largest quarterly decline since the financial crisis. The one shining light in the fixed income world was the global high yield market, where a combination of shorter duration and hence less sensitivity to that movement higher in rates, alongside spreads that were still above where we started 2020 and the strong economic backdrop, meant that we generated small positive returns to start the year. The Unconstrained Fixed Income Fund and ETF has been positioned this year in anticipation of a pickup in growth expectations and a move higher in government bond yields. The portfolio duration has been reduced from a high last year of around 6 years to about 3.5 years at the end of the first quarter. This reduction has occurred predominantly through selling US government bond futures in anticipation of higher US Treasury yields. As we expect global growth to improve, yet also expect central banks around the world to remain accommodative, this is an environment where we believe risk markets should remain supported. The fund and ETF has been adding to its high yield credit allocations, which now make up around a third of the portfolio, as well as continuing to be invested in both investment grade credit and emerging market debt. The portfolio still maintains an overweight to emerging market currencies, as a rebound in growth globally should support pro-cyclical economies. Although we have diversified the funding basket to include lower yielders like the euro rather than just the US dollar. As we look forward, we see an above-trend global growth environment driven by both extremely accommodative monetary and fiscal policy, alongside accelerating vaccinations which will allow widespread reopening of economies. This is an environment where we expect real US GDP growth to reach a 38-year high. However, we must be cognizant that a lot of this good news is already expected, with equity markets at record levels and core government bond yields significantly higher than they were at the start of this year. Thank you for taking the time.